So Brexit negotiations, trade wars, new sanctions on Iran, EM currency weakness, uncertainty between Italy and the rest of the European Union, all of these are factors that really should have seen gold prices trading much higher than where they are at the moment. In fact, gold prices are down 5%. But it's not just gold. The rest of the commodities complex is down for the year to date, with the exception of palladium and some of the agricultural commodities as well. There are two themes that have really dominated the commodities complex as a whole so far this year, and we think those are two themes that are going to persist in 2019 as well. The first is the trade wars and the implications for China's economic growth, and the second, geopolitics. But just because we think these two themes are going to continue into 2019, that doesn't mean that we think gold prices are going to be under pressure again in 2019. In fact, we think price risks are skewed to the upside. There are a number of event risks taking place in 2019, ranging from the countdown to Brexit, planned and potential elections, and also the potential end of the US rate hiking cycle. So all of these could have some upside risk for gold prices. So kicking off with Brexit, as we know, next Tuesday, December 11th, the UK Parliament will vote on whether to accept the deal or not. And the current numbers that our economists have collated do not look particularly encouraging. So at the moment, when we look at the risks, and assuming that this vote fails, there isn't really a clear roadmap to what the path looks like to the 29th of March next year. The outcome could be potentially a second referendum, it could be a leadership challenge, it could be another general election. There isn't really much scope at this stage to change a withdrawal agreement as it stands. But for the UK as a whole, we've already seen a decline in asset investments, and that uncertainty is likely to persist in seeing more outflows. Gold's initial response to the EU referendum was a positive one. In sterling terms, gold gained 20%. In dollar terms, gold was up 5%. So gold initially reacted as a safe haven asset. And even when we saw the withdrawal, saw Article 50 being triggered, gold reacted as a safe haven asset. Speculative investment rose to all-time highs, open interest was at an all-time high, and in that period, over the uncertainty over the EU referendum, we saw inflows equating to around about 365 tonnes. So gold was playing its role. But what we've seen thereafter is that gold hasn't really responded. And then gold's response next year will really come down to whether there's a deal and when we exit, or there's no deal exit, or it's something in between. If there's a deal that when we leave, at that point, our economists and our FX strategists believe that we're likely to see a relief rally. They think there's a lot of pent-up investment demand, and you could see both sterling and stock markets firming. But if there's no deal, that's a scenario where they paint a much more negative picture. We could see at least a quarter of negative growth in the UK. And of course, the Bank of England report last week painted a much more dire picture in terms of an 8% decline in GDP. In this situation, where you could initially see at least sterling and euro weakening and the dollar benefiting from safe haven demand, that's a scenario where gold could come under pressure again. But thereafter, if the risk of recession rises in the UK, potentially in Europe, and you get a risk of recession globally, that's a scenario where gold is more likely to come back into play as a safe haven asset. So trade tensions is a factor that has impacted the whole commodities complex. And following the G20 summit, both President Xi and President Trump agreed to halt any new tariffs being implemented for at least 90 days to see if they could come to an agreement. So our economists have worked out various scenarios on what the implication could mean for China's GDP growth. And they've estimated that with the 25% that's already been implemented on $50 billion of Chinese imports, in addition to the 10% that was implemented on $200 worth of imports, and if that was to rise to 25%, you could see a 0.6 percentage point decrease in China's GDP. So we estimate around about 6.5% for next year. That could fall to 6% if all the tariffs were implemented. So far, we haven't necessarily seen the negative impact of the trade tensions. That was until a couple of months ago. And now we've started to see a downturn in global trade volumes, and we've started to see a downturn in global trade value as well. But gold prices haven't necessarily reacted to these trade tensions just yet. In our view, we either need to see an easing of the trade tensions as we did over the weekend, and in turn seeing the dollar benefiting less from safe haven flows and gold benefiting more so, or we need to see an escalation of those trade tensions where gold comes back into play. What we have seen instead, as I mentioned, is the dollar benefiting as a safe haven asset. But equally, as the dollar has benefited, our China economists have noted that in China, it hasn't just been the CNY weakening because the dollar is strengthening from safe haven flows. They've also noted that there's relative differences between the two when it comes to interest rate differentials or when it comes to balance of payments. So yes, the CNY has weakened, but it hasn't just been because the dollar has strengthened. But gold has suffered because the dollar has strengthened and the correlation between CNY and gold has strengthened at the same time. So there's much speculation that if CNY trades down to 7, gold prices would actually fall down to $1,200. But that's not our base case scenario. We do think we're likely to see CNY trading towards 7 in Q1, Q2 in 2019, but we don't think it's likely to remain at those levels, and we should start to see a turning point. And especially if trade tensions start to ease, at that point you could actually see the dollar benefiting less so from safe haven flows and perhaps gold benefiting in a weaker dollar environment. So China's GDP growth, we've estimated it at around about 6.6% for 2018, and we think it will decline to about 6.4% in 2019, falling to 6.3% in 2020. But what our economists have noted is that it hasn't been the trade tensions that have weighed on China's growth just yet. It's been many domestic policies. We've seen deleveraging and pressure on the housing market. We've seen a decline in fixed asset investments, in retail sales, and these have been the main drivers that have actually pressured China's GDP lower. But if we look at the commodities complex as a whole, at least what the base metals prices are telling us is that they're pricing in a much more severe contraction in the China economy than what the data is showing us at the moment. Gold has differed in that respect. If we look at the World Gold Council data, metals focus data for the first 3 quarters of this year, it shows that China's gold demand has risen by 4% for the year to date, while local prices have actually been broadly flat or down just about 2%. So China's demand in terms of gold consumption has actually been relatively robust. If we look at imports into China from Switzerland, they're up over 50% for the year to date. And if we look at gold imports across all the major hubs, they're up around about 20%. So China's gold demand at this point hasn't necessarily come under pressure, even though there are signs that China's GDP will come under pressure in the coming months. So we've got a picture where Brexit could potentially pose an upside risk. China's demand has been relatively robust, but that contrasts with India's demand, which has actually been quite weak so far this year. Q3 bucked the trend and we did see an increase, but it's important to bear in mind that Q3 last year was particularly weak because we saw the implementation of goods and services tax in India pull forward a lot of the demand. So demand recovered relatively in Q3, but for the year to date, it's relatively flat and currently it's quite weak. But India's made some headway in terms of implementing some important policy changes that could improve the market and create stability in the market much longer term. So in the budget this year, it announced developing gold as an asset class, it announced wanting to develop a spot exchange, and it also announced wanting to revamp the gold monetization scheme as well. So all of these factors are towards developing a much more established market longer term, not necessarily boosting demand in the short term, but certainly helping to offset some of the declining trends that we see at the moment longer term. But next year, general elections take place in India in April or May. If we look at the last set of general elections back in 2014, the gold market was in disarray. There was much discontent. Back in 2013, we'd had the Indian government increasing import duty all the way up to 10% in a bid to try and reduce the current account deficit. And then we'd had the implementation of the 80-20 rule as well. So we saw gold demand and gold imports in particular plummeting back in 2013. And around the election time of 2014, the market really wanted to see a change and wanted to see the 80-20 rule being overturned. The new administration did make some changes to the 80-20 rule. They allowed some private banks to be able to import gold without having to use the 80-20 rule. And if you recall, the 80-20 rule required that 80% of imports were for domestic use and 20% of imports had to be exported. So fast forward through to November, the new administration banned the 80-20 rule in its entirety, and the gold market started to recover and we started to see imports recovering as well. So around the last election, there were some important changes that took place around the time of the election in terms of the 80-20 rule and import duty. This time the question is whether we'll see changes in the new administration, given that there are all these positive changes taking place in terms of longer term policy. In our view, we're not likely to see a big change. Our economics team expects there to be a continuation in the current administration as it stands. But I think what's going to be more important for the India market in 2019 is going to be the gold price. We've seen a high sensitivity to prices trading to 32,000 rupees per 10 grams. And when prices come back down to 30,000 rupees per 10 grams, demand picks up. But when they're elevated, that demand is really under pressure. And I think that's going to be a much more determining factor in terms of how India's demand pans out next year. And then we have a market where the physical market has been broadly weak overall. But perhaps one of the most important drivers is going to be the Fed hiking cycle. Leading up to each hike, we've seen the gold market come under pressure. And the market continues to expect the Fed to hike in December. The market's pricing in a 75% probability. The Fed dot plots suggest that we'll like to see between 1 to 2 hikes in 2019. And if you look at the market pricing, the Fed dot plots pricing in 2 to 3 hikes, but the market is pricing in 1 to 2 hikes. Our economist thinks it will be a bit more aggressive than that, and we're more likely to see 4 hikes. But either way, whichever one you take, it's likely to see the end of the Fed hiking cycle. So that drag on prices should start to ease. But on top of this, we've also had a very negative environment for US Treasuries. Our rate strategists have noted that it was a negative environment at the start of the year. This time last year, the market was forecasting 3 hikes for 2019. The market was forecasting US GDP growth at 2.4%. Instead, we're looking at 4 hikes for 2019, and US GDP growth is at 2.9%. So we've seen fiscal stimulus boosting US growth, and that's led to an increase in issuance of US Treasuries as well. This year, they think it's more likely to be a more positive environment for US Treasuries, i.e. we start to see Treasuries start to fall. And this is because they think we're going to need to see a much bigger increase in consensus expectations in terms of US growth expectations. So our economists expect US growth to actually start to decline in 2019 to 2.6%. So I'll just touch upon inflation. It's not our base case that we'll see a spike in inflation next year. In fact, we think in the US we'll see inflation around 2.5%, in Europe around 1.7%, in India around 2.5%, in China 2.5%, and in India just below 5%. But we've had more conversations in the past few weeks where the market participants talking about the potential for an inflation spike next year. So inflation expectations haven't started to tick higher, but gold fares well in an environment where you see high prolonged inflation, i.e. above 5%, and if it's unexpected inflation. So if that unexpected inflation does materialize, we could actually expect to see an uptick in gold prices. So bringing this all together, there are a lot of upside risks for 2019, but whether this will materialize into higher prices, I think will really depend on how stable that floor is. I think there are 2 factors that have materialized over the course of 2018 that suggest we're likely to see a much more stable floor for gold prices going forward. And those 2 factors are central bank buying and ETF demand as well. So in terms of central banks, we've seen buying around about 390 tonnes so far this year already, which surpasses full year buying of last year around about 374 tonnes. And we estimate for the full year we might see buying around about 430, 450 tonnes. But that alone is not the key reason why we think it's much more supportive. We've seen many new entrants in the gold space, ranging from India, Poland, Hungary, Malaysia, Iraq. The fact that we've got new buyers coming to the market, some making substantial purchases, like Hungary bought 28 tonnes, sets a much more robust floor for the gold market. But ETFs are much more robust as well, much more resilient. We've only had inflows of just over 10 tonnes so far this year compared to 200 tonnes last year. But what I think is more interesting is if we look in August when gold prices dipped to 1167, at that point, all of the inflows since January 2017 until August, there was around about 200 tonnes that had become loss-making, unprofitable when prices were trading at 1167. And then we started to see outflows. In gold, the market is not like silver. Gold investors don't try to hold on to loss-making positions and riding out the storm. They're much more nimble. We started to see outflows in August. We had the highest outflow since in a year, around about 43 tonnes. And the outflows persisted in September. But But in October and November, we started to see inflows. So even now, there are about 150 tons that are loss-making. And those gold investors are not liquidating those positions, and they could be. So I think these investors have become much more resilient. But digging a little bit deeper into who's holding this gold, if we look at peak gold holdings across the ETFs back at the end of 2012, at that point, the top 15 holders represented just under a fifth of all of the gold ETPs. And now obviously most of them have scaled back exposure. Now they represent just 7% of total gold ETPs. But what I find interesting is that although most have scaled back, only one has exited their gold positions entirely, and a fifth of them have actually increased their gold exposure, looking at current prices as value entry levels. So ETF holders have become much more resilient. So the upside for gold is really driven by the macro environment, and our FX strategists expect to see the dollar starting to weaken next year. Not dramatically, but at least starting to see the turning point in the dollar. They expect the euro dollar to trade to 1.2 towards the end of the year. And they think that the peak optimism or the peak enthusiasm around the US should start to subside. So we should see less enthusiasm around the stock market. We start to see stock market correction. We should see growth starting to slow down as well, and the market starting to price in the end of the Fed hiking cycle. As the Fed comes towards the end of its cycle, Europe should start to commence its hiking cycle towards the end of 2019. So it's not necessarily going to be a factor that drives gold prices substantially higher, but it's certainly going to create a much more favourable backdrop for the gold market. So I'll just quickly touch upon the fact of gold's safe haven status has been questioned so far this year. In terms of safe haven buying, it's mostly been localised, whether it's been in the UK or Germany. And here I've just looked at Iran and in Turkey as well. In Iran, we've started to see an increase in gold demand over the last 2 quarters. And the demand is rising to levels that we last saw in 2013. If demand was to increase, and it's mostly been bar and coin demand, to 2013 levels, we could see an increase in buying of around about 60 tons. In Turkey, we're a little bit further on from that response. We started seeing that initial safe haven demand materialising at the back end of 2017 into early 2018. But now local investors are turning to gold in a need for liquidity rather than in the initial stages as a safe haven asset. So safe haven buying has been more localised rather than broad-based, which is what gold really needs to be able to push prices higher. What I think is encouraging for the gold market is that when we've seen the recent equity market weakness over the past few weeks, gold prices have responded. So we did see that push higher. And technically, if we see gold prices trading above 1240, 1250, we could start to see those ETP holdings that were loss-making not being vulnerable anymore. And we could actually start to see much more interest in supporting gold on the downside. And if the dollar starts to become starts to weaken, as we expect it to do in 2019, that could expose prices to the upside. So overall, we think that the market has a much more stable floor. It's found support from central banks. It's found support from ETFs in an environment where we have very weak physical demand. The upside continues to rest with the macro picture, whether it's the dollar, whether it's the Fed hiking cycle. And we do expect the Fed to reach the end of its hiking cycle in 2019. But we think there's still a number of event risks that are not our base case scenario. But if you did see them materialise, such as those around Brexit, such as an escalation in trade tension or easing trade tensions entirely, or potential planned elections, such as those around in Europe or a potential election in Italy, those could push gold prices higher. We expect gold prices to average 1,300 in 2019. Thank you. If you have any questions, I'd be happy to take them.